May 12th, 2022, just another Thursday morning, until it wasn't. By the time most traders had their coffee, the crypto market was already bleeding. Bitcoin was down, Ethereum was down, but that wasn't the story. The real story was a coin most casual investors had never heard of, and a stablecoin that was supposed to be as safe as cash. Within 48 hours, that stablecoin would be worth 10 cents. Its sister token would drop from double digits to a fraction of a cent, and roughly $300 billion, more than the GDP of most countries, would vanish from the crypto market. This isn't just a story about a price crash. It's a story about a promise that broke, a panic that spread faster than anyone could contain it, and a domino chain that took down some of the biggest names in the industry over the following months. This is how it happened. To understand why this crash hit so hard, you need to understand what came before it. By early 2022, crypto had just come off one of its biggest bull runs in history. Bitcoin had touched an all-time high, retail investors were pouring in, and in the middle of it all was an algorithmic stablecoin called UST, built on a blockchain called Terra. Here's the pitch. UST was designed to always be worth exactly $1, not because it was backed by cash in a bank like other stablecoins, but through a clever bit of financial engineering involving a sister token called Luna. If UST's price dipped, the system would burn Luna to bring it back to $1. If UST rose too high, it would mint more Luna to bring it back down. In theory, a self-balancing machine. To make UST even more attractive, a lending platform called Anchor Protocol offered investors an eye-watering return, nearly 20% annual yield just for holding it. Billions of dollars flowed in, chasing that yield. At its peak, UST's market cap crossed $18 billion. Luna, the token propping it all up, became one of the largest cryptocurrencies in the world. It looked unstoppable. Analysts called it one of the smartest innovations in crypto. Retail investors and institutions alike treated it as a safe place to park money and earn a return other markets couldn't touch. But a system that depends on confidence only works as long as everyone keeps believing in it. And in the first week of May 2022, that belief cracked. The unraveling didn't start with a hack or a scandal. It started with withdrawals. In early May, large sums of UST began moving out of Anchor Protocol, hundreds of millions of dollars pulled in a short window. Then came a series of large, coordinated sell orders on UST itself, dumped onto exchanges in a way designed to put maximum pressure on its dollar peg. Nobody has ever fully agreed on whether this was a calculated attack or simply market panic finding the system's weak point. What's not in dispute is what happened next. UST slipped below $1, just slightly at first, a cent, then 2. In a market built on the promise that this coin would never move, even a small crack was enough to trigger fear. And fear, in a system like this, is fatal, because of how the peg was designed to fix itself. Remember, to bring UST back to $1, the system had to mint new Luna and sell it. So as more people rushed to sell UST and escape the falling peg, the protocol minted more and more Luna to absorb the pressure. But Luna's price was falling too, which meant the system had to mint even more of it to make up the difference. It became a spiral feeding itself. More UST sold, more Luna minted, more Luna sold, less value backing UST, more panic, more selling. Within days, Luna's supply exploded from around 350 million tokens to over 6 trillion. Each new token diluted what remained, until the price was, for all practical purposes, 0. This is the part traders still talk about with disbelief. Not that the peg broke, but how fast the death spiral consumed a top 10 cryptocurrency once it started. By May 12th, the numbers were almost impossible to process in real time. UST, the stablecoin, was trading as low as 10 cents on some exchanges. Luna, which had traded above $80 just weeks earlier, was down to fractions of a cent, a decline of more than 99.9%. Terra's ecosystem alone had erased tens of billions of dollars of value in a matter of days. But the damage didn't stay contained to Terra. Panic in crypto rarely does. As Luna and UST collapsed, investors across the entire market started pulling money out of anything that looked remotely risky, which, in a falling market, is everything. Bitcoin, which had already been drifting down for weeks amid broader economic pressure, dropped sharply. Ethereum followed. smaller altcoins, many of which had no connection whatsoever to Terra, got dragged down in the wave of forced selling and liquidations. Add it all up. The direct collapse of Terra's ecosystem, plus the shockwave through the rest of the market, and roughly $300 billion in total crypto market value disappeared within that stretch of days. Leveraged traders got liquidated by the billions as exchanges automatically closed out positions that could no longer cover their losses. For thousands of ordinary investors who had trusted UST as a safe place to hold their savings, the loss wasn't theoretical. It was their actual money, gone. What made this crash different from a normal bear market dip wasn't just the size, it was the speed, and the fact that it exposed something uncomfortable. An asset marketed as being as safe as cash could go to zero in under a week. The Terra collapse didn't end when the price hit zero. It was the first domino in a much longer chain that played out over the following months. Crypto lending platforms that had exposure to Terra, or to the funds that had bet big on it, started showing cracks almost immediately. Celsius Network, a major crypto lender managing billions in customer deposits, froze withdrawals within weeks, trapping user funds indefinitely. Three Arrows Capital, a hedge fund that had taken a massive position in Luna, defaulted on loans across the industry and collapsed into liquidation, taking a web of lenders down with it. The contagion kept spreading through the rest of the year, as firms that had quietly lent to each other discovered just how tangled their balance sheets really were. By the time the dust settled months later, several of the industry's biggest names, platforms millions of people had trusted with their money, had gone from too big to fail to insolvent. It was, in many ways, crypto's version of a bank run, except this time it started with a single broken promise on a Thursday in May, and it took the rest of the year to fully play out. So what actually happened here, underneath all the numbers? At its core, this wasn't really a story about crypto being risky. Everyone already knew that. It was a story about the danger of a system that depends entirely on confidence to function, with nothing solid underneath it when that confidence disappears. UST wasn't backed by dollars in a vault. It was backed by belief, and by a second token whose value depended on that same belief holding steady. The moment enough people stopped believing, there was nothing left to catch the fall. The warning signs, in hindsight, were sitting in plain view. A near 20% yield on a stable asset isn't a gift. It's a signal that something underneath is working harder than it should to hold together. Explosive growth built on a single incentive, rather than genuine diversified demand, tends to unwind exactly as fast as it built up. That's the part that gets forgotten every time the market moves on to the next headline. The crash itself is easy to remember. The charts, the losses, the panic. What's harder to remember, and far more valuable, is the pattern underneath it. Unsustainable yield, concentrated trust, and a system with no real floor once the selling starts. Crypto has crashed before this, and it's crashed since. But May 12th, 2022 remains the day that proved even the things marketed as safe in this market can disappear in an afternoon, and that the fastest way to lose $300 billion is to build it on a promise nobody can actually guarantee.